Let's pick up with Rupert Thompson, Associate Director of Strategy and Research at Kingswood. Rupert, nice to have you with us. I've got you down as the CIO as well, so let's just flag that up. Let me ask you, we've been talking a lot about another rotation into value and cyclicals being underpinned by a vaccine and recovery in economies into 2021. But what is the risk that this just represents another false dawn for the value trade?
Well, certainly, if you look at the experience of the last 10 years, you'd have to say that's on the cards. It's just going to be yet another value rally which doesn't last for too long. Our view is that actually this value rally this time does have rather more legs to it. And I think the difference this time is that, first of all, next year, what are you looking at? Despite the fact that short term, you're looking at renewed, possibly a double dip in Europe and the UK. In terms of next year, you're looking at strong and rising growth. And possibly more, even more important, you're probably looking at a slow upward trend in bond yields. And both of those are normally associated with rotation into value. So I think it has got legs to go. On a 2 or 3 year view, sure, it's still a sort of low growth environment. For another 6 months or 12 months, I think value is the place to be.
Where do you go for that value, though? Because I know that there are also questions being asked as to whether the United States continues to remain favoured by international investors, or whether it's now time to more broadly move away from the dollar and take advantage of the valuation gap in perhaps Europe and some Asian markets.
I think you're right, and I think the value rally has sort of various aspects to it. One is sort of buying value stocks, one of it is sort of buying value sectors, and the other aspect is sort of buying value countries or regions. And as you sort of just alluded to, if you want sort of value countries or regions, what you're looking at is the likes of Europe, Asia, EM, and I have to say the UK. The UK actually, on our sort of screening, actually looks the cheapest of the lot relative to how cheap it normally is. And I think all of those you should be looking at rather than the States. Having said that, do you want to disregard the States altogether? No. Just like any market, you've got value elements in that, and the sort of scope for catch-up within the value sectors within the States is probably as great as elsewhere.
Rupert, it's hard to disagree with you, except for the fact that all of these amazing cyclical stroke value sectors, they have structural issues as well, as far as I can see, whether it's the banks with fintechs, whether it's the airlines in the energy sector with the transition, whether it's autos with a similar factor as well. So whilst I appreciate value has cyclical natures, are there structural barriers to seeing a whole multitude of these sectors actually rallying and actually readdressing some of that disparity?
I think you're right. Longer term, I 100% agree with you. There are still structural issues affecting these sectors, notably sort of the disruption you're getting from the tech sector. And also the fact, beyond this sort of cyclical, strong bounce in economies you're looking at next year, down the road, you're still probably stuck in a low growth, low rate environment, which, favours growth stocks, not value. So the values run's got further to go, but, on a 2 year view, I think you could well be looking at growth stocks again.